Hi folks, welcome to another episode of Who Said What. I'm your host Krishna, and for those of you who are new here, let me quickly set up some context for what this show is about. See, the idea is that I'll pick the most interesting and juiciest comments from business leaders, fund managers and the likes and contextualize things around them. Now, some of these names might not be familiar, but trust me, they're influential people, and what they say matters a lot because of their experience and background. So I'll make sure to bring a mix. Some names you'll know, some you'll discover, and hopefully it'll give you a wide and useful perspective. Now, for all the sources mentioned in this video, don't forget to check out our newsletter. The link is in the description. With that out of the way, let me get started. So over the past week, a lot of things have happened that together tell you where the whole AI story really is right now and how absurd, tense and strangely revealing it's become. Starting with OpenAI CFO who recently said that they are talking to the US government about loan guarantees for their $1 trillion data center build-out. Basically, she was saying this infrastructure is too big and too expensive for private markets alone, and we might need you, that is the government, to help underwrite it. Now that's quite crazy. OpenAI, the most valuable startup on the planet, and its CFO is out there saying in public that they might need the government to back their spending. Now the logic behind this is quite simple. This stuff costs too much money and doesn't last long enough. The servers, the GPUs and the data center power, all of it depreciates fast. Government backing would make it cheaper to borrow because the risk shifts to taxpayers. Now there are more interesting things that have happened. Michael Burry, the guy who's famous for his bet against the market in 2008, has now disclosed a $1.1 billion short bet against AI-related stocks. Now at the same time, Deutsche Bank, which has lent billions to the data center industry, started looking for ways to hedge its exposure. Basically, ensure itself in case this AI infra boom goes wrong. And the best thing out of this whole week was when Sam Altman went on a podcast with Brad, who's an investor in OpenAI, and Satya Nadella. Brad asked him a blunt question that everyone has been talking about for the longest time. How can OpenAI, with around $13 billion in revenue, commit to $1.4 trillion in spending?
How can the company with $13 billion in revenues make $1.4 trillion of spend commitments?
And the reply was just bold. He said, first of all, that $13 billion figure is wrong.
First of all, we're doing well more revenue than that. Second of all, Brad, if you want to sell your shares, I'll find you a buyer.
Now that's wild. But here's where things took another turn. Because right after all of this noise, Sam Altman put out a long clarification post. He said OpenAI does not have or want government guarantees for its data centers. He said that we believe government shouldn't pick winners or losers and taxpayers shouldn't bail out companies that make bad decisions. But what came right after matters more. He said there's a version of government involvement that does make sense. Not backing private companies but governments building their own AI infra. A strategic national reserve of computing power, like an energy reserve, but for compute. The government builds it, the government decides how to use it. The only place OpenAI has even discussed loan guarantees was for semiconductor fabs, helping secure domestic chip supply. Now that's not about bailouts, that's industrial policy. Same logic as the CHIPS Act. So he wasn't just walking back on the CFO's comment. He was reframing the whole conversation away from OpenAI needs government help toward the government should think about compute like it thinks about oil or energy. See, the reason all this is such a big deal is that these are not small numbers. $1 trillion of spending is closer to the scale of national infra. And this is where Ben Thompson's piece on strategy really helps make sense of it. He says, yes, this is a bubble. But not all bubbles are bad. Every big technological leap from railroads to the internet starts with wild overspending. That's what builds the foundation for the next era. The dot-com bubble gave us too many bankrupt startups for sure, but it also gave us the fiber optic cables that power the modern internet. He calls this kind of a thing an inflection bubble, the good kind, the one where too much money chasing the future ends up creating real lasting capacity, roads, power plants, data infra. And he says AI could go either way. On the one hand, it's scary because so much money is going into GPUs, short-lived assets that age fast. But on the other hand, all this spending is already forcing real-world build-outs, new chip fabs, power generation, and a whole layer of physical capacity that will outlast the hype. Now he points out that Microsoft and Amazon have both said their biggest bottleneck isn't chips, it's power. They're building 15 to 20-year assets just to keep up. If AI ends up forcing the world to generate more clean, abundant energy, then even if the bubble pops, it will have left something real behind. Now that's the hopeful version of the story. That what looks like reckless spending might actually be kind of accidental industrial policy, a moment where ambition and mania accidentally build the future together. Now coming to the second story.
We see a lot of helmets coming into our showrooms, which is a good sign because people who had never considered buying a car before, they are now actively considering.
Now that line came from Maruti Suzuki's latest earnings call. Now on the surface, it sounds almost trivial. But for a company that has spent the past 2 years lamenting the slow death of the small car, it's quite a turning point. Helmets in the showroom mean something deeper. The two-wheeler customer, long frozen out by price inflation and EMIs, is finally crossing over. Now to understand why that matters, it helps to remember where Maruti was just a few quarters ago. A while back, R.C. Bhargava, the chairman of Maruti Suzuki, had said that 88% of the country is not participating in the car growth story. That's because entry-level cars are just not growing. Now the problem wasn't supply, it was affordability. The same tone carried into the first quarter of this year. Here's what Rahul Bharti had said.
The affordability issues in the entry segment cars continue to affect the growth of the industry.
Now for a company whose identity was built on first-time buyers, it was an admission that its own base was eroding. The mood in those calls was defensive, cautious and tired. And then came the latest quarter. The numbers tell the story of a sharp turn. In the festive period starting 22nd September, the same day the GST cut kicked in, Maruti recorded about 5 lakh bookings compared to 3.5 lakh the previous year. Retail sales nearly doubled from 2,11,000 units a year ago to around 4 lakh this time. Of those, roughly 2.5 lakh units came from small cars, a growth of almost 100%. Now for a company built on small cars, it almost felt like Maruti had stopped believing in them. Now for a while, they had been saying the same thing, that affordability had collapsed, that the middle class had stalled, that first-time buyers weren't coming back. So when small cars suddenly started moving again, it wasn't just demand reviving. It was Maruti rediscovering its own audience. The GST cut in September helped, of course. It made the numbers line up again for people who had been priced out. But the bigger shift was emotional. The company that had written off the bottom of the market was now seeing it come back to life right in front of them. But there's still caution in the air. Now even Maruti admits that some of this demand could be deferred or festive in nature. But the sentiment has flipped. The company's narrative has moved from helplessness to momentum about pent-up demand finally finding release. Now that's it for this episode. See you in the next one. एक्चुअली अच्छा दिख रहा है, फ्रेम में आ रहा था. ओके, मैं इधर रख दूँ. Michael Burry, who's famous for his bet against the market in 2008, has now declared.